Every single day you show up to work, you do your job, you try to take your hard-earned savings and keep that. You're trying to actually maintain your wealth over a long period of time, and yet there's a small group of people who decide what your fiat currency is worth. And can you believe it that there's some information out there that's not being shared by anybody? I don't understand why this isn't front and center. I call it the money mirror method in this video today. For those who stick around, I'm going to show you just that. And what is it all about? It's going to explain how we can actually look at the system, look at the cycle, and really pinpoint where things are going to move. It's so simple, and yet why the other guys out there in the alternative media don't highlight it, because it doesn't get the clicks, because it doesn't get the views. Today's video, number one, I'm going to show you about the 65 trillion, not the 100 trillion that some used to get a lot of clicks, because I did a video about this recently. They quoted 100 trillion. This is 65 trillion of debt. Number two is the Federal Reserve, the central bank of the United States, is in debt. They're losing money, if you believe it or not. And the third thing is the answer. You got to stick with me. I'll bring it all to you. Let's begin. I wasn't kidding when I said $65 trillion in debt. In fact, it's hidden debt by non-US bank and shadow banks looking at what they had to say here. This is Visual Capitalist, a resource I use all the time simply because I can explain something really easily by showing it to you. I cover this data all the time. In fact, I covered the $65 trillion of debt previously, and this is just a great way to reflect on that. The era of easy money has contributed to a ballooning $65 trillion in hidden dollar debt across the global financial system. Please allow me to reiterate that despite people wanting to use $100 trillion or $80 trillion for that fantastic YouTube title that gets all the clicks, the information is 65 trillion. This debt is in the form of currency swaps, which have grown nearly twofold since 2008. So we had the financial crisis, big concern, big problems. And so we want to fix that, right? We want to make sure it doesn't happen again. We don't want to have any problems like we did in 2008. So the best thing to do is simply let this expand much worse than we have ever seen in history. Oh, you mean that's not going to be a good idea? Anyway, one party borrows a currency while lending another. So in this case, they're showing you dollars and euros. These must be exchanged back at a future date in a swap contract. These contracts are considered a form of debt. Often this debt is not recorded on the balance sheets due to bank accounting rules. You can't make all the rules that would actually prevent banks from having any scrutiny, or in this case, non-banks from having the scrutiny on them. That would be terrible. We need to get these things to balloon up so fast and so massive that they must have implications on the financial system. Therefore, a crisis allows an opportunity, but that crisis is, of course, many years down the road whenever they first think of these things. Unrecorded bank debt is growing, US dollar denominated debt, and you could see for yourself, it grows further and further and further. Looking at the main risk factor, exchange rate volatility, sharp swings in USD could spur liquidity crunch. US interest rate volatility. What happens when you increase interest rates? You encounter problems that are supposedly unforeseen. Unrecorded bank debt is 2 times greater than recorded dollar debt. It is extremely important to realize how big this all is. And this chart shows us that. We're looking at the non-US shadow bank on balance sheet debt. Compared to the total, it looks like nothing. This is unbelievable. I mean, we're looking at this at a time in which we were told they were going to make everything safer in the financial system. They were going to ensure that we would not encounter a problem in the future, and yet look at what they're doing. I'll break that all down for you in a few minutes. But let me show you what else I have. Because it's not just the US, it's not just the West. China's hidden debt. How much is it? And what is Beijing doing to curb the financial risk? So this goes deep, but I'll just show you something for a moment. Debt levels among China's local government financing vehicles, LGFVs, are an issue of growing concern for authorities. Beijing has begun tightening bond issuance criteria for LGFVs and ordered local governments to clear existing credit by 2028. We have yet another possibility of crisis. If we do not understand how big these things are and where the money flows in and out of, we are going to be encountering a crisis in the future. It might not be tomorrow, it might not be next week, but this debt is a monster. It's a tsunami that will make an impact on your life. But if you want to understand where things are moving to and from, if you want to look at why the stock market does what it does, this video has that information for you. Those who have the patience will understand. You gotta have the patience. Hang in there. You could see hidden debts still exceed municipal bonds. This is just giving you an idea of whenever we have, I don't want to call bonds real, but whenever we have something that is real, look at the amount of, physical resources, gold, land, real estate, all these physical assets. And then you compare that to what happens in the financial system. It is absolutely gluttonous as far as I'm concerned. Their debt will never, absolutely never be paid back. A crisis must be created intentionally in order to bring in a new monetary system, yet people don't want to hear about it. So why is this coming up now? Why am I showing you this today? And why have I been harping about this for over a decade now? Because the writing is on the wall. Many people do not want to look at it, but for those who are here, I want to thank you because you're about to see why this is all coming to fruition today. Here we have it. The era of cheap money is over. How debt is hitting home for many consumers as interest rates soar. When you go through the cycle, you encounter a problem. Analysts say that many other US consumers remain in good financial shape, thanks mostly to low unemployment. They don't even know what the heck they are talking about. And you got to realize here, I've seen different numbers, but you can look at it for yourself. According to Bankrate, the average annual rate for credit cards is at 19.2%. That's a record high. Never seen anything like this before. Bankrate data shows it would take 16 years for someone to pay off their current average credit card balance of $5,400 by making the minimum payments at 19.2%. At that point, they would have shelled out $7,300 in interest alone. So you're going to pay more than double by paying the minimum. And you see how this can crush people because they're not just going to take that amount of debt and then say, okay, well, that's it. I'm never going to take out any more debt. No, it piles on and on and on. And you encounter problems down the road. Credit card interest rates are heading to 20% on average. You got to understand where they're going. They're going higher and higher, just like mortgage rates and just like, of course, interest rates in general. What does that do? Higher borrowing costs put this pressure on people and they will be unable to pay their bills. You encounter higher delinquency rates and more crises develop. In fact, look at this. Consumers roll over debt without knowing their interest rates. I thought this was shocking. Look, another 46% of US credit card consumers don't pay off in full. Soaring inflation is making its way into card balances. I've talked about that before, told you as the trend was basically reversing, going the other direction from 2020. I said, watch this, keep an eye on this. And here we are today. It's very clear. More people in debt. Inflation is hitting them hard. Look at it, 46% of US credit card consumers do not pay off in full. That means they're carrying this balance on average is $5,400 in change, and that has a very deep impact on the economy as a whole. We need people to constantly consume. This is a consumer-driven economy in most countries today, and you look at it as a way for the companies to continue their corporate profits, and of course, this facade of a healthy economy to continue. It's a facade, believe it or not. And here we have gold. Gold has continued to rise. It is now over 1900, and this is partially for many reasons. Of course, you have the inflation factor, you have the lack of desire for, holding on to fiat currencies in general. Physical metals always in shortage. We have other things. Seasonality is a little bit part of this. You have the central bank purchases. Looking at China, looking at India, they're always buying it up. Looks like they have this voracious appetite for the metal. Also, bonds. Bonds being less attractive. If the yields aren't there, we turn to gold. Lots of stuff happening, but of course, showing you the price over 1900 at this time. I want to break down exactly why we have a very big concern today, and I want to explain it very simply. Trillions of dollars in currency swaps within shadow banks can be a concern for financial stability because shadow banks are not subject to the same regulatory oversight as traditional banks and therefore may engage in risky behavior. Additionally, shadow banks often have complex and opaque financial structures, which can make it difficult to assess the risks that they are taking on. This lack of transparency and oversight can lead to a buildup of systemic risk, as was seen in the 2008 financial crisis, when the failure of large shadow banks like Lehman Brothers and Bear Stearns contributed to a global financial meltdown. Since the financial establishment exists at a higher order than the government structure, there is no stopping shadow banks from continuing to grow, expand, and take as much risk as necessary to ensure too big to fail remains in place. That's the system that we are dealing with today, and there seems to be no concern, absolutely no concern, from any of the political nonsense, fake left-right paradigm parties whatsoever. Welcome to the new world, my friends. This is basically just looking at loan loss provisions. The banks, the big four, JP Morgan, Wells Fargo, Citi, Bank of America, are setting aside capital knowing that they're going to have people who can't pay their bills. That's the situation, okay? So they're doing that today. They had the same thing earlier on in 2020. Now we get it once again, continues to increase, okay? I just want to make that very clear because it shows you that the banks are aware of this and they're dealing with that today. We'll see if it actually results in much more delinquencies. We have noticed that somewhat, but I want to see higher levels to really make that the potential for systemic risk. This is just showing you the Federal Reserve. My goodness. Federal Reserve Board announces Reserve Bank income and expense data and transfers to the Treasury for 2022. Well, look, this is explaining it in depth. This is directly from the Federal Reserve's website, of course. They announced preliminary financial information indicating that the Federal Reserve banks had estimated net income of $58 billion in 2022. Breaking it down, during 2022, Reserve banks transferred $76 billion from weekly earnings to the U.S. Treasury, and in September 22, most Reserve banks suspended weekly remittances to the Treasury and started accumulating a what? Hold on. Deferred asset. Deferred asset. They're using this term, deferred asset, very unusually. What does that mean? It's a loss. It's a loss. The term deferred asset is used multiple times in this press release, in this statement by the Federal Reserve. They're losing money because of higher interest rates, because of this, I wanted to say another word. Anyway, we'll call it silly system that they've built which is simply designed to give money from the taxpayer, from the honest person, give it to the banking establishment. It's so clear and obvious. Same situation with the Bank of England. Treasury bails out the Bank of England for the first losses on QE program. And of course, nothing will change there. It's going to be most of the banks, if not all of them, doing the same thing. Fed total interest payments, reserves plus reverse repo to financial institutions, money just flooding towards the banks. And this is what happens throughout this part of the cycle. You stayed with me until this part of the video. I want to thank you for doing so. We are going to analyze what I believe is the simplest, the easiest way to know what will happen in the future, to understand it in depth. And yet, it's so simple. Do you see these two lines? Do you want to guess what that is if you can't read the text? One of those lines is the US exchange market cap. That's right. Stock market. Blue line is the stock market. The red line is the balance sheet of the Fed. US reserve balances with Federal Reserve banks. These two are mirrored. In fact, you saw what happened with the stock market. And isn't it so coincidental that the balance sheet rose considerably throughout that exact same period? This happens over and over again. I call it the money mirror method. I didn't necessarily, take a look at these two things. I was the first one to take a look at it, but I've been highlighting this for as many years as I can remember here on this channel. It is extremely important to analyze these two things to realize what's really happening. You are not seeing valuations of corporations matter. You are not understanding that it doesn't matter how many cars Tesla sells or how many iPhones Apple sells. What is more important is the money mirror method. This is something that I have been showing you for years, for literally years on this channel. I hope you've been paying attention to it. You can decide for yourself what you want to do with it. I can't give financial advice, but you watch it closely and you can do potentially good things. I want to stop right there. I want to talk to you just to say thank you for making it this far into the video. I appreciate you being here. Every single day, you will get information that is unbiased, non-political, and data-driven. If you're interested, hit that subscribe button down below, and I'll see you tomorrow. Take care.